Hello, I'm Andrew Keane from Edison Group. We're pleased to have with us today Ross Driver, Managing Director at Foresight Group and co-manager of the Foresight Solar Fund. FSFL pioneered solar investing as a UK listed investment trust and now has assets over £700 million. Ross, welcome. Thank you for your time today. My first question is really on solar in general. I mean, the IEA this year is talking about solar investment outstripping oil and gas investment globally for the first time ever. It's always been an important part of the journey to net zero, but why is solar having such a good growth period at the moment?
Well, firstly, pleasure to be with you. Great to be here. So I think going through it, if you go back, I think it was back to about 1993, solar was making up about 2% of the UK energy portfolio. That's now getting up to a level where it was about 15-20%, so it's been growing quite significantly. And with the push to net zero, it got to a stage last year when renewable energy generation was making up about 85% of the total for a little while. The benefits of why solar in particular, because the UK obviously has good wind resource, got other factors. Solar in particular, it's comparatively cheap. It's probably the lowest cost form of clean energy generation, and it's relatively quick to deploy as well, which means that you can roll these projects out at quite a quick space of time. The other thing I'd say to that as well is the reliability of solar too. There can be times when wind is up and down, so it's good to have a balance and a mix in the system there, as well as the base load that things like nuclear could provide. But we tend to say that day usually follows night in these circumstances. It doesn't need to be that it's the sunniest day ever, but it really helps with the reliability factor for solar.
And in terms of Foresight Solar's strategy in the sector, I mean, what stage of investment do you normally look at assets? Are they developing or are they operating, and has that changed over time?
Yes, I think you're right. It has, the investment thesis has changed over the years. When the fund started pretty much 10 years ago now, it was mainly a case of buying operational, already built projects. What's changed in the time is that the subsidies, the original ROC subsidies, have rolled off. We've got different mechanisms to supporting it now. And also to support the level of returns, as I think there's been a lot more investment into the sector, in some ways driving down those returns for or increasing the valuations of those initial subsidy-backed assets. We've subsequently moved into the construction phase, which is what we did when we entered Australia and now subsequently in Spain. And going in from an earlier angle allows two things. It allows us to be more on top of the projects through constructing them out, overseen by our own teams, but will also give a higher level of return and allows us to sort of uplift the value of the projects once they get through to construction completion as well. Last year, we also changed the mandate to move into development stage portfolios as well. Now, they'll have a higher level of risk attached to them because you're then investing in projects, a pool of projects that haven't actually got planning or grid consent necessarily at that stage. But the benefit of that is you can actually acquire these rights for a lot less invested capital up front. You could be acquiring a portfolio for single-digit millions, but with the opportunity for those projects that progress to make significantly bigger returns from those. And we'd also be able to sort of mark up the valuation of those as they get through planning permission, but also as you construct and build them out. I would just say finally, if we're looking to build up a development pipeline in a number of geographies and also in both solar and storage, we won't necessarily keep all of them ourselves. Some of them we may sell out to the market to recycle capital in that way as well.
I was going to ask about geography because you're traditionally been very UK focused, but you have assets in Spain and in Australia. How do you think about geography in terms of regulation, returns and diversification?
Sure, we do see the benefits to having a diversified portfolio, and I think the results we put out recently have shown that actually, that you can balance when the radiation or the sunshine, the level of it in one country is up or down, you can balance that out, and especially having a really broad spread across the globe like that as well. The way we think about diversification in other markets to move into, the rationale for clearly the fund like many in the space, were all born out of here in the UK and mainly growing off the back of the subsidy-backed projects that we had here. When the fund went to Australia in about 2017, the rationale for going there was we have projects, again, that we're putting out a similar level of subsidised government-backed subsidy there. So you had 20-year PPA offtakes that are guaranteed by the states. And even that continues to develop. You won't necessarily find those kind of contracts these days. We look at geographies that are clearly secure, the government is secure, but also the regulatory framework in which you work in as well. When we went to Spain and did our first investments there, as well as saying Spain, well, actually, when we went to Australia the first time, Foresight was growing a presence in Australia, so we had boots on the ground there. We have a Madrid office that's been active for many years now as well, who are able to source, have the local connections and able to source those deals for us. Part of the Spain hasn't had subsidies for quite a long time now, but what it does have is a very deep liquid market for PPAs to be able to get off the shelf. So these are long-term power price agreements. They'll typically be a fixed price, but they're with AAA rated off-takers at multinational energy companies.
How do you think about price exposure in the portfolio? You know, managing volatile wholesale prices. Do you forward fix, and how does that program work?
Yeah, so I think that's something, like to say, with Foresight and the team we have, it's actually run by our portfolio management team internally, the forward fixing. Predominantly I would say the exposure is on the UK assets, because historically it's been about 50% of the revenues have come from the subsidies, and then about the other 50% have come from electricity sales, us selling the generation out to the market. And on that, what we've typically done is we have, again, framework agreements with multinational, large AAA rated energy traders or electricity power companies that will buy that electricity off us. We have a pool of them that we work with, and we have framework agreements with them that last for multi years. Now, if we didn't do anything else on those, we'd get the day ahead pass-through rate. They'd keep their couple of % for their commission in terms of doing that. But what these agreements allow us to do is fix 6-month blocks all the way out for up to 5 years in advance, depending on how much liquidity there is in the market. So typically higher liquidity in the near term, going out to declining into as you get out to 27, 28 at the moment. But what we'll do is look to fix blocks of those at prices that we see are supportive of where we think the dividend is going to get to in the next couple of years. So that's our portfolio team are in constant. We're getting prices through on a weekly basis. We have there's a lot of interaction with those guys. They will know the prices we're looking to fix at, and we actively do that to build the revenue stack over the coming years. What I would say is we're not energy traders. We're not trying to second guess the market. As macro as it gets for us is coming out of the pandemic, it felt like power prices were going to rise. We left a bit more of the portfolio open to merchants exposure that literally paid dividends with the cash that we got in through that. And then last year, it felt more like we were at the top of the roller coaster about to come down from those high power prices. So we've fixed a lot more over the next few years. So that's the way we think about power price hedging.
The issue of discount rates is pretty topical for most listed investment trusts. As base rates have come up, discount rates have come up. The sector is somewhat derated as a result of that. I mean, how do you think about discount rates, and what does that do to your assumption of returns and target returns of your pipeline?
No, absolutely. It is probably the most pressing point at the moment, and there's a real disconnect out there in the market in terms of, I think, returns expectations from investors versus what we think are the fair value of the assets. And I'd say that disconnect has really come around because we've had the fastest rise in the base rate, Bank of England, but you look around the world, the Fed, elsewhere, the base rate has jumped from about near 0 to 5% plus in both markets. And it's the fastest increase that there's been in decades. I mean, even if you go back, we're at the same levels we were in the financial crisis back in 2008. But that step up 14 consecutive rises. This is probably what's created a disconnect between the pricing here. It's understandable that I think institutional and investors will look at this and say, well, if I can get 5% or 4.5% on the 20-year gilt, I'm going to require more of a premium over that in order to invest in. It's not just us; it's the entire real assets market. I think where there's the disconnect is that we know from the transactions that we see in the market that assets are changing hands still at a much lower discount rate than the market is implying. So we've upped our discount rate for, say, UK solar assets to 7.5% for this year. The Foresight Group, that's the manager that sits behind the fund as well, we know sold a pool of assets, solar assets of a similar vintage to ours for a much lower price than that only back in February. In fact, it was such a lower price that the solar fund wouldn't make sense to acquire them for that level of returns. So that's where the disconnect is, and it's a lot at the moment. There's still a lot of money out there in private funds that was raised years ago that's still looking to deploy. And you look at these inflation backed subsidized assets, and they're still in very high demand. I think the thing here, it's probably a question of timing. And one thing will happen, either the gilt rates will start to come down, and investors will probably start to feel comfortable again in that, or what could be actually a longer lag is for the asset pricing for some of that dry powder that's out there that's still happier at the lower returns to be used up. But that's where the disconnect is at the moment. And I'd just add to that ourselves and the board, though, feel strongly that this disconnect is undervaluing in the share prices, undervaluing the assets. And that's why we're looking to buy back our own shares, because we see that as an investment in ourselves at a 20% discount is one of the best uses of money that we can put it to if we feel that actually the real value of these assets is significantly higher. So we'd say that we do see the stock as cheap at the moment.
How does asset recycling come into that strategy? You know, you've recently announced an intention to perhaps pursue that as part of your broad strategy.
Yes, and it's something we've been thinking about for a while anyway, with certain assets. But I think it's also very important at times like this. It goes to that whole point around proving what the assets are actually worth as well, and if you can recycle capital into the fund. I think you have to look at it and say at the moment it's going to be really quite difficult to know when the markets could turn. So the way we're looking at this at present is there are assets that we've identified that we'd be comfortable selling. We're clearly comfortable that we could sell them at least the book value and more than that, which is the difference to how the market's valuing us at the moment. And we take that. There's two things we'd look to be doing with the receipts from those sales. Is one, to actually pay down some of the short-term debt that we've got. So virtually all our long-term debt, which is about 400 million, is all hedged out multiple years till the early 2030s. It's the short-term facility that ourselves, a revolving credit facility that ourselves, and to be honest, the whole sector uses similarly. The rates on that are increasing at the moment with the increase in SONIA. So we'd look to pay that down, but we'd also use these proceeds to fund, recycle them. When you talk about recycling, it's actually taking something that you think the valuation or the value of the project is maximised, take that out and then put it into more accretive returning projects.
Dividends, you're trading, I think, at about an 8% yield at the moment. You're well covered in terms of cash coverage for that. How do you think about dividends as part of your overall strategy, progressing that versus further growth and further investment?
Yeah, it's a very good point, and I think the dividend point is a keen one. I think it's fair to say that historically, most of the funds in the sector as well, ourselves included, have been looked at as just very strong yield plays, which works very well when the gilt rates are on the floor, nobody can get much in their bank accounts or anything like that. You're looking at it and a 6 to 7% yield was looking attractive at the time. We know, and ourselves as manager and the board are very keenly aware, is look, the macroeconomic environment has changed. In 18 months, gilt rates have shot up now, so there are other options out there. So I think it's important that we're offering that still the strong yield, and we feel that the increase that we've given in the dividend does that. The dividend increase will be progressive, so the intention is that it will increase every year. The question is by how much, which other factors such as inflation and other increases will play into. But at the same time, we're also looking to add in a modest level of capital growth into there as well. So it's not just that we're looking to be a strong yielder with capital growth in there as well. And that's where we see the investments in, or the development stage assets that we can mark up several times as they go through those processes, but also the newer investments such as battery storage. We think have higher levels of return. We'll be building and constructing those projects out, so we'll buy the rights to them. And again, as they go through the construction cycle, we should be able to de-risk them and mark up the valuation. So you should be able to see some uplift in NAV from that as well. And a good example of that was for the full year of last year, we brought our full Spanish portfolio through construction into operations, and that itself added about 2p to the NAV there. I think in some ways the power prices have really skewed things a little bit, because there's been huge up. There's probably going to be a little bit of drawback there, but whereas we would like the power prices to be a lot more stable. Really, that's why we have our hedging. We want to sort of mitigate the troughs like we saw in the pandemic, and in some ways the peaks that we've seen elsewhere. Having a stable view of revenues and power prices for us is more beneficial, because that would allow us to then deliver on the solid yield and also be able to, I think those NAV increases from the works that the manager is doing would be more obvious out of that.
So from an investor's viewpoint, what are the core aspects that are part of the offering? And it's yield, it's growth, but it's also clean energy as well.
Absolutely. Well, look, firstly and foremost, we're an investment trust, and what we're looking to do is give a high quality yield with that modest element of NAV growth in there. We know that's what investors are looking for, and I think actually it's a very, a circa 8% yield at the moment. It still remains very attractive to what else you can get elsewhere in the market or different asset classes. But sustainability is also sort of in the DNA of everything that Foresight does. We are a sustainable investment manager. So being able to couple the two, and we've been doing this for sort of 10 years now. It's the 10-year anniversary of the fund, investing in solar projects, and now other aspects such as battery storage, part of the energy transition. So to be able to take the knowledge that we have in sustainable real assets and apply that to what is hopefully an attractive investment opportunity, I think is very timely at the moment. Also, with the drive to net zero across sort of the whole world, really, it's also tapping into this major growth opportunity that's out there at the same time.
Thank you, Ross, for joining us today to discuss FSFL and the broader solar investment landscape generally. We encourage investors to visit Foresight's investor page on Edison's website or the Foresight website for further details. Thank you for joining us.